I'm Charlotte McLeod with investingnews.com, and here today with me is David Hunter. He is Chief Macro Strategist at Contrarian Macro Advisors. He's been doing this for over 50 years. And first time on the show, I'm really excited for the conversation. Thank you so much for being here.
Yeah, hi, Charlotte. Great to meet you, and thank you for having me on.
Of course, as I said, excited to have this conversation. And I think many people in our audience will be familiar with you and your views. But since it's our first time talking, I was thinking if we could start with your expectations for a broader melt up, and if you could talk about where we are in that melt up process at the moment.
Sure. Yeah, I've been talking about a melt up for some years now, and said that ultimately we would see this what I call a 43, soon to be 44-year secular bull market come to an end this year. I think we will see in the final stage a parabolic run into the top, and I believe that has begun. So if you look at, even if you look at it from probably a monthly standpoint on the charts, weekly or monthly, you'll see that we are coming out of, we corrected in March for the war, and we're coming out of that in a very vertical direction. And I think a lot of people are thinking it's gone too far. They don't understand it. Well, I think we are just getting started in that final, what I'd call a final stage rally into a top. My target on the S&P is 9,500. So I think from today's levels, you're probably just under 30%. The Dow, my target is 65,000. Similar type thing. It's a little over 30%, I think. NASDAQ, 32,000 is probably more like 24 or 5% from here. And the Russell 2000, I think, can get to 3,800, which is probably a mid 30s, 33, 34% from here. So we're looking at still a big run. I think that could happen in the next 2 or 3 months. As crazy as that seems, I just point to silver back in December, January, where it went from 50 to 122. That's what a parabolic looks like, and that's what I think this is going to look like, is a very steep run. That doesn't mean you can't have down days or even down few days, but ultimately, I think most of the time here in the next couple months is going to be heading directly north.
Okay, so those targets you mentioned in the next couple of months, several months, I wonder if you can talk about what is the trigger? What do you see pushing those indexes higher? Because you're right, a lot of people, especially people I'm talking with right now, are thinking these have already gone so far, they can't continue higher. So what are you looking at to push them there?
Yeah, first, I'm a contrarian, so sentiment is very big for me. And we've been in spite of the fact that we're, more than a double off the lows in October of 2022, Dow was 3,500 then. I mean, the S&P was 3,500 then, and we've more than doubled from there. But in spite of that, you look and sentiment is relatively subdued. It's obviously not at a extreme bottom like it was maybe April of last year. But it's still pretty subdued, and I would call that a wall of worry that provides the fuel for the next advance. So, investors have remained skeptical all the way up here. At different times they get on board the bandwagon a little bit, but every time we get a sell-off, they get bearish again. And that's really what's happened here during this last couple months with what's going on in Iran. Investors are nervous. They see the run in, obviously, the semiconductor area, and particularly Micron, and they see the run in the AI area, and they say, well, that's fine, but I think the rest of the market's not really carrying its water and is showing signs of rolling over. I disagree with all of that. I think essentially this market's going to broaden out. You're going to have a very broad rally into the top. It's not only sentiment. Sentiment provides a good backdrop in terms of providing fuel for the advance. As I tell people, at the top, everybody will be all in. So right now, you're not close to that. Yes, people are starting to raise targets because the market's up at all-time highs, but they're looking for 200 or 300 points in the S&P, not not a couple thousand points. So I think we have plenty of room for sentiment to move from skeptical and cautious to all in and very bullish. As I say at the top, you'll hear comments telling you that this thing has a long way to go, that there's still a couple of years left in this bull market, et cetera. Those will be the signs that we're getting closer to the end. Right now, that's not the view. Everybody's kind of looking for the exit, not the entrance. Other things that can drive this: lower interest rates, lower dollar. Earnings have been great, and they will continue, I think, through this next quarter or two to be really strong. So that helps. And then, of course, the big one right now is Iran, because Iran's caused the sell-off prior to this run, and Iran is holding back lots of different different markets like the metals and the bonds, et cetera. Everybody's worried about the spike in oil prices when it went from in the 60s up to 120, and now it's back down into the mid 90s. I think if Iran can get resolved, if we obviously got news today that's encouraging, whether it's another false start or not, we'll see. But if Iran can get resolved, some kind of an agreement, I think you'll see oil very quickly back into the 70s and ultimately 60s. And I have a target of 30 in oil in next year's bust. So we can talk about that later. But so lower oil prices will bring on lower interest rates, will bring on more bullishness from investors. And I think lower oil price will also mean lower dollar. So all those things I think will kind of come together and cause this last run. But more than anything, if you think about it, the herd has either gotten more cautious or gotten out of the market. Hedge funds are short the market. And all of a sudden, if you get this change in Iran, because that's what triggered that, they're all going to be coming in a fairly concentrated period, meaning the next few months. And I think that can take you, up 20 or 30%, maybe more. I'm not going to be surprised if my targets, as aggressive as they are, prove conservative.
Definitely Iran is a big question mark right now, especially this week as we have these negotiations continuing to go on. And what I hear from people about it is even if it wraps up today or tomorrow, the conflict, the fallout could continue. So inflation due to higher oil prices, all the supply chain disruptions. Do you see that wrapping up perhaps more quickly than other people see it? Or how are you looking at that, the long-term impact of the Iran war?
Yeah, I hear that a lot. That's, certainly it's across the airwaves constantly. And I disagree with it completely. The markets anticipate, so oil can move down. Now, that doesn't mean you resolve all the supply issues and everything. Obviously, the oil has to move about the world and get into those places. But oil itself will discount what's going on, and you will just as fast as you saw oil go from 60 to 120, you'll see oil go from the 90s down into the 70s and then below. People, I think, misunderstand markets. Markets discount the future, and the stock market and the metals markets and the bond market aren't going to be paying attention to when is that tanker getting to Germany or when to Europe. They're going to be paying attention to the spot oil price and the futures price in oil. So I think that's all misguided. I think some of it is driven frankly, by the derangement syndrome the media has for Trump. And as a result, they see everything through a very clouded glass, a very negative glass. Whatever he does, they're going to be, and Wall Street's not as bad, but there's plenty on Wall Street with that same bias. And that bias, I think, is causing a very clouded understanding of what will happen. So, yeah, I very much disagree. Not that it's easy, not that it's all going to just clear up and everything goes fine, but I do think that we have just passed the maximum period for negativity versus, on oil and negativity on the markets. If you just look at today from a technical standpoint, silver came out of a descending triangle and went vertical. Interest rates have dropped several basis points. 10-year dropped from over 440, whatever it was, 442 down to 435 in a hurry. The dollar's dropped 50 cents or 50 there, so that I think what you're seeing is exactly what's going to happen as we go forward, is that there's plenty of room for these things that have been kind of stuck in this place to move the other way, and in a very bullish way for the markets over the course of the next weeks and months.
Let's go back to what you see coming for oil prices before we get too far away from that. So you're mentioning oil could go as low as $30, which is very low compared to where it is right now. Can you explain how that would happen? And then what happens for oil beyond that point? What's the longer term view?
Sure. So I've had for a long period of time a view that we're heading for a global bust. So as bullish as I am about the next few months, I'm probably equally as bearish or more bearish on what comes after that. So I think we've got, very simply, not to get off oil, but this kind of explains it. We've got a situation where you've got 330 trillion in debt around the world, both sovereign and private debt, and that's far beyond anything we've ever seen in any previous cycle. I think that leverage on the system the next downturn will be impacted big time by that leverage, and take what might have been a serious recession, but a regular recession, into something far worse, something that could be worse than 2008-9, what I call 2008-9 on steroids. So it's really that leverage that I think can do that. It will impact the stock market. I think the stock market can drop 80% from its peak. I think it will impact the metals. It'll impact all commodities, and it will impact oil. And oil right now is 95, let's say. As I said, I think it can go to 70 next step, and then into the 60s, and maybe even into the 50s as we move into the summer. And then ultimately, when you have that bust, and it's probably pretty much a 2027 story now, although it could hit late this year, I think that will take oil down to 30 or thereabouts. If you remember what happened in 2008-9, I mean, oil went to, was it 2008-9 that oil went to negative? Or was that 2020? I can't remember. But when the economy worldwide goes into a recession, and what I think could be a pretty serious recession, demand for oil will drop. Our oil supply will have all been resolved, and it will take prices down pretty sharply. So now the other side of that is that, let's say we have a global bust that pretty much occupies 2027, could spill into 2028. The other side of that is that the response to that bust, because global bust for me means something worse than an ordinary recession, not as long as a depression. So it happens pretty fast, kind of like 2008-9 did. But it also comes with a big financial crisis because of all that leverage. So you're going to have a situation where you're going to have a lot of bank failures kind of dominoing around the world. It will require a big response from all the central banks. There's no other real solution when you've got a financial crisis that's happening fast. You will see money poured into the system, big QE in the U.S. and big money elsewhere. Every central bank will be printing money like there's no tomorrow, bigger than we saw in 2020, much bigger than we saw in 2008-9. And it's that massive money. I'm saying you could even, out of the Fed, see as much as 20 trillion, maybe a little more. That would take you a balance sheet, from the from the peaks of 9 trillion in response to the 2020 downturn, it could take you as high as 30 trillion in the balance sheet. So that's unheard of. I mean, we did 5 trillion in 2020 and 21. We did, 3.7 trillion in response to the Great Recession in 2008-9. So to be talking about something that could be 20 trillion is far beyond anything we've ever seen. It will reverse us. It will, stabilize the financial system and ultimately turn that back up. It will turn the economy back up with a lag. And ultimately what it will trigger with a lag of a couple of years is a big inflation-driven commodity run, where you'll see oil go maybe from, if I'm right, about $30, from $30 to potentially something like $500 in the early 2030s. So it won't all happen at once. It'll happen over several years. It could happen slower or faster than I'm talking, but I generally say, in 5 years or a little more, you could go from 30 to 500. And obviously that's way beyond anybody's expectation at this point. But that could be what we're looking at. It will be have the company of pretty much every commodity out there going through the roof. Copper could go to $20 and natural gas could go to $50 or more. So I think we're looking at a inflation cycle unlike any we've experienced in the world, in terms of, and I was investing. I was a pension fund manager back in the early 80s. And, we saw basically inflation get up to 20%. I think this time around, inflation will maybe get up to 25%.
Well, you answered my question. I was going to ask if we're heading into something that's similar to different situations we've seen in the past. It does sound like this is pretty unprecedented in terms of where we're heading. The other point I wanted to bring up is the Fed. How much attention are you paying to the Fed right now in terms of what's coming? I know we're in a transition right now between Powell and Warsh. People are keeping a close eye and wondering, is Warsh going to be somebody who falls in line with what Trump wants, which is lower rates? Is there going to be some resistance there? How much attention are you paying to those dynamics right now?
Yeah, good question. Unlike, I think, most of the street, I am not paying a lot of attention to it or giving a lot of weight to it. I mean, it's pretty obvious, I think, that Kevin Warsh is going to be the next chairman. And obviously, we've got the drama about how long Powell's going to stay on, et cetera. I basically, the statement I make is that macro will trump the Fed. So it's pretty much, no matter who is going to be chairman, although I'm really pleased with Warsh as a selection. I mean, he's got the monetary background. He's got a lot of experience. He's even had the Fed experience, FOMC experience. So I'm not making light of that selection. That's a really good selection, but I'm not caught in the drama of, thinking he's the determinant of where the markets are heading or where the economy is heading going forward. Frankly, I think the macro will be dictating to him as it would have dictated to Powell or anybody else in that seat, that when you're faced with a what I think will be a bust and a financial crisis, you can talk all you want about wanting to shrink the balance sheet and get it back to a normal level, normalize the balance sheet. That can be a long-term plan, but I think it's going to be disrupted next year or late this year, next year. And I don't think his plan, when he talks about getting it back, we went from an $875 billion balance sheet in 2008 to almost a $9 trillion balance sheet in 2021. When he talks about getting him back into a normalized place, maybe he's thinking 2 or 3 trillion. I don't think you're going to see that anytime in the next several years. You're going to be going the other way. So I get his desire, and I support it in terms of saying, yeah, we need to get back to where we're not using money to kind of fix everything, because it ultimately is going to be very inflationary. But I just think we're so far along in this that he's coming in too late to be able to do what he would like to do now. And he understands he can't disrupt everything, so he's not going to do it all at once anyway. But I think my guess is that the bust is going to come along too soon for him to have shrunk the balance sheet much. And in fact, if he tries to shrink it this year, let's say this fall, it could be, just adding to the problem, because I think we are heading for a recession. So money matters a lot in my work. And so I get the longer term approach or longer term desire. I just don't think it's going to be possible given the macro picture that's coming. And this macro, global bust is not something coming from, 1 year of policy. This is a buildup of many, many decades of very bad policy, many decades of a Congress that overspent, many decades of presidents who had a lot of misspent or misallocated, and basically policymakers across the board around the world doing a lot of things they shouldn't have done. And I think we're at the end of what I call a super cycle, the long cycle between the last depression, which was the 1930s, and the next depression, which I think is going to be the mid 2030s.
Great context for us to have there. And I want to make sure that I bring up the bond market as well, because I believe you've got an interesting take on the 10-year yield. I wonder if you could unpack that in terms of what you see coming.
Yeah, just like everything else in my forecast, it's a little extreme. And I have to tell people it's not a personality thing. I'm not trying to be bombastic or it's really where we are in the long cycle, the big cycle. I believe we're going to have one more lower low in interest rates in the next couple of years. So we got down to a 0.4% 10-year back in 2021. I believe we're heading for probably a 0% 10-year in the global bust. So, and I think we are at this point in time probably in the process of coming out of a bottom in the bond market and a top in rates as we speak. In other words, we've spent 2.5 years here, almost 3 years, in a long bottoming formation in the bond market. And I think in the coming weeks, we're going to emerge from that bottom and see the 10-year go below 4% and ultimately go below 3%. And then in the bust, head all the way to zero. And 30-year, which I hear a lot of calls for, 5% on the way to 6%, and that there's just too much treasury debt, too much government debt for them to get for the long bond to go down. And obviously, rates backed up here recently, so it feeds that frenzy, that, the expectation that that's just the beginning. I actually think rates across the board are peaking, and that the 30-year probably will drop to something like 1/4 or 0.5% when the 10 years down to zero. And short rates probably will go negative. So, we've got rates there in 2 and change level. I think they can go all the way into negative territory. Not that anybody desires that, but if we have a global bust, you're going to have a big, obviously the big money input, the printing of money, and at the same time, falling demand for money or falling, both the banks won't be lending and across the board, there'll be a lot less demand. So it will push rates down very sharply. It'll be temporary because on the other side of the bust, when we get that big inflation cycle, rates will follow inflation, and you could see the 10-year back up towards 20%, certainly high teens, and 30-year as well, and T-bills probably even higher than 20 if inflation goes to 25%. So this is kind of we had a secular bull market in bonds that began in 1981 when the 10 and 15 year, I think, were around 15%, and short rates were around 21% on T-bills. And we've come all the way down over 40 plus years. And I think this is that last final move, just like in the stock market, where the bonds go up and rates go down, and then you bottom out in the bust, and you begin another big bear market in bonds.
Again, really important context. I want to also, of course, fit in where precious metals are in your scenario. So we have the melt up phase coming, then we have the bust. And I'm wondering what you see for gold and silver prices as we're going through that process. And perhaps we also talk about what happens during that broader commodities super cycle that's further into the future.
Yeah, so I have targets this year for gold of 6,800. I've moved it up several times over the last couple of years. I had a target at 3,000 a few years ago when it was down in the 1,800, 2,000 area, and then raised it to 3,400, and then 4,000, 5,000, and then 5,500, and in February, after the sell-off in both gold and silver, I raised it to 6,800, and that's my current target for what I call a pre-bust target, or it could spill into the bust, but basically it's my target for this year. And then for gold, on the other side of the bust, in that big inflation cycle, I think gold can go to 20,000. And that would be in the early 2030s, not 2030, but 2031, 2, 3, somewhere in there. My target on silver has been raised several times as well. I had a long held target of 75 when silver was back in the 20s, even the teens. I said it can break out from the old highs of 50 or 48 and go to 75. I had that for several years. I raised that last year to 100 and then 125. When silver went from 50 to 122, my target was 125. So it had pretty much gotten to my target, and it was parabolic. And I could have easily looked at that and said, well, that's it. That was what I was looking for, and we're there. And parabolics usually end cycles. I didn't. When it sold off and went down into the 60s, basically down to mid 60s, I raised my target to 180. And that's where I am today on that. And again, that's a this year target. Could be there this summer, might spill into fall, but I think we're going to see it pretty fast. We've spent the last few months, really since that peak at 122 on silver and, at 5,500 on gold, we've spent the last few months kind of consolidating that big run. That was a huge run in both metals. And then the war hit. It might have come out of the consolidation much sooner, but the war hit, and it took another, I didn't expect it at the time, but instead of what I thought had been a retest, it went to new lower lows. At least silver did, and gold did too. And we've kind of been fooling around for the last month trying to figure out what direction to go. A lot of technicians and a lot of traders have taken the bait and gotten bearish here and said it's going back. Silver's going back to the 50s, and gold's going back under 4,000. I did not. I kept saying I think we're close to a bottom here. We're very near an inflection point, and I think today, pretty much, assuming this isn't just going to be one day news and then we go back the other way again, I think today may have been that turn back up, that we've completed the consolidation, and we should see a pretty fast run, meaning over the next few months, 3, 4, 5 months, with silver going from the mid 70s here up to 180, and gold going from where it is now up to 6,800. Post bust, gold can get to 20,000, as I said, and silver can get to 1,000. I had thought 500 was going to be kind of a crazy number, and after seeing what we've seen this year, I had to raise it. And I think silver at 1,000 may sound crazy, but I think that's very doable for early next decade.
Well, I have a hard time calling any targets crazy at this point because just given what we've seen this year, I do want to ask. So, gold and silver prices much higher in the near term and also the long term. But when we're in that bust phase, are you thinking about lower levels that they could go to, the bottom that you might see there? Any thoughts on that?
Yeah, it's a great question, Charlotte. People keep asking me for a target in the bust, and I go, I got to see where it ends up first. Now, I have 180 on silver. Michael Oliver has a 300 or higher number on silver. So I don't say anything's impossible today, just like you said. And so I don't have a number in terms of the bust, but I do think the likelihood is that in the bust, all assets are going to get hit hard, except maybe treasuries. But silver could fall 50, 60, 70% or a little more because it is so cyclical, and it will have will have been bid up so high. And gold, less so, but it could still fall 30 or 40%, maybe even a little more. And that's obviously not so crazy anymore when you see what happened after January. I mean, we saw a 50% hit in silver in days. And we saw gold go down 30% or more. So I think, that makes sense to me that you will see 40, 50% gold and maybe that much. And, 70, maybe more in silver. No guarantees. I mean, they could hold up better than that, but they're going to be hit hard one way or the other. And then coming out of the bust, that will present a very big buying opportunity. Because if you can, let's say my 180 is right, and you go down, more than 50%, let's say you get back to 70. You could go from 70 to 1,000 in less than 10 years, and certainly 5, 6, 7 years. Gold, let's say it gets back down from 6,800 back down to the 4,000 area, 4,500 area. It can go to 20,000 in that same 6 or 7 years or less. Those will be great opportunities. What we'll see next cycle, I think, is because of rising interest rates, sharply rising interest rates where they go double digit, and because of inflation, the indexes, the broad indexes like the S&P and the Dow and the NASDAQ are going to be held back as PE, the market multiple gets shrunk. PE multiples get shrunk because they're the inverse of interest rates, right? So if rates go up, PE multiples tend to go down. You could be back in a period where normal PE multiples are more like low double digits or single digits, because inflation's really taking a toll. And so it's going to be a cycle of commodities. As I said, copper can go up a lot, natural gas can go up a lot. I think even ag commodities could go up a lot in the next cycle. And so those things will be able to outpace inflation. And certainly the stocks connected to commodities like miners or oil stocks or oil service stocks, they're going to be able to outpace inflation, so their stocks can go up. Whereas, let's say, steady growers like the foods or the drugs or things like that, consumer stocks in general, they're going to have a harder time because they're going to be facing cost pressures, and they're not going to be able to produce earnings that can come anywhere close to what inflation's doing. And so their stocks are going to, at best, tread water and probably go, in many cases, go down. So they'll be underperformers. And again, for people that are in indexes, I like to recount the fact that, because I've been in this business 50 years plus, I remember when in the mid 80s, the financial industry decided we're looking at the rat going through the snake. The baby boomers are now reaching a point where they're going to start accumulating assets for retirement. They've bought their houses, they've bought their furniture, and they've got excess money that they now are starting to put into savings and retirement savings. And so the financial industry knew that they had this new trend coming that was big, and they said we got to figure out something that kind of we got to get away from our kind of churn and burn type of approach to investing, where a broker dials you up and says, I got a stock idea for you, and they moved to the idea that it's time in the market, not timing the market. And that mantra has been around for 40 years. And for those that followed that, which is the majority, I think, of retail investors who index, they bought into that, and they've made out like bandits, because the S&P's had a great run. All the indexes have had great runs, and you were much better off most of the time just buying and holding and let it go from cycle to cycle. So we've seen in many cases, and I think in the majority of cases, those that did that from the mid '80s on have outperformed most money managers, most professional money managers, active managers. And so, that's still the mantra out there, and that's still the belief that, hey, there's always a higher market next cycle. Yes, the cycle has corrections, and yes, the cycle has bear markets. But if you just kind of play the steady as she goes, buy and hold, you'll be bailed out by the next higher high, and the higher market cycle to cycle. I think we're making a final top this year in a what will ultimately probably be a 44-year secular bull market. That high may stand for decades, not a decade, but many decades, just like the high in the Japanese market in 1989 was not surpassed for many decades. I think that's what we're looking at. This is a very big picture top that you won't get bailed out by just stocks always going to higher highs. We're so conditioned for 40. If something happens for 40 years, that's something that people think is forever, but it's not. And I do think that we are looking at a situation where you have to kind of think about changing your philosophy, changing your strategy from time in the market to timing the market. If we, in fact, are, and again, I can be wrong, so I'm not saying I know, but if I'm right, if my thesis is right, that we're making a 44-year top, and then followed by what could be as much as an 80% bear market, obviously it would make sense to take advantage of this run we've had for 40 years and get defensive, maybe get out of the market, be in cash or be in treasuries, where I think they will continue to provide you, if not positive returns, not negative returns. And treasuries, I think it'll be positive returns. And then prepare to redeploy the funds as we get through the bust, but redeploy them in areas other than indexes, maybe, into commodity stocks or commodities, or funds that are oriented in that direction. Because the other thing that's going to happen on the other side of this is, if you look at an index, it's most heavily weighted in the leadership of this cycle, right? So technology and AI and semiconductors, those kind of things have got very high weightings in an S&P, for example, whereas oil's got a very low weighting. It's, I don't know what it is now, but it was just a few percentage points. It may be up to 5% or more now, but it's still a very low weighting. Commodities are generally pretty low weightings. And although they'll be in the bust, there'll be changes in that. Ultimately, the heaviest weightings are the last cycle's winners. And so if you buy an index, you're positioned all wrong, because you're positioned for last cycle's winners and not the next cycle's winners. So again, it will behoove investors to think through that process with their financial advisors and move more towards what invest for the future, not invest using a rear view mirror. And so I don't think most people think that way. They kind of just do things as they've worked for so long. They just say, hey, why should I change? And most of the time they've been right to take that attitude. we're coming up to a very big turning point where that won't be the case.
Very strong and clear message, I think, for us to wrap up on. But before I let you go, I want to ask if you can tell us where we can find you online if people want to follow you or learn more.
Sure. I am on X pretty much every day. And I generally reply to questions and comments more so than I think most people. People don't always like my comments or my replies, but they do get responses generally. I get a lot of repetitive questions, so I don't always respond if it's one that I've answered already. But I don't do a lot of original posting. I just found when I did original posts, I got so many replies to that I couldn't keep up. And so I just kind of gone to this model where I reply to people, and then that's how I communicate with the following I have. So if you're not set up on X to get replies, you're going to miss me. And I do have that occasionally where people will say, you haven't been on for, they happen to see a post of mine. And they go, where have you been? You haven't been on for months. And I go, I'm on every day. It's your settings. You're missing replies. You're looking for original posts. So that's where I hang out pretty much every day. And then I also have a quarterly investment letter that I put out. I've been, I was first a money manager on, equity pension fund manager for a number of years, among other institutional money management jobs. And then my last half of my career, I was a macro strategist, as I am now. I began writing the letter that I am still writing back in in the year 2000. So it's been 27 years. I several years ago decided I speak plainly enough, write plainly enough. I think it's good for institutional investors, but also for retail. So I started offering it to retail, and it is available out there by subscription, which means there's a cost to it. It's 4 letters a year, and there's an annual subscription fee. If people are interested or might be interested, they can send me an X chat message, and I'll provide details.
Well, perfect. And we'll have your link to the X in the video description so people will be able to find you. And thank you so much for coming on. This was a really fun conversation, and hope to have you back in the future.
Yeah, that'd be great. Thanks, Charlotte. It's great to see you.
Amazing. Well, once again, I'm Charlotte McLeod with investingnews.com, and this is David Hunter with Contrarian Macro Advisors.